Welcome to the complete series recap for a SC 480, Distinguishing Liabilities from Equity. This video brings together all 6 sections into a single consolidated review. Whether you are refreshing before a client engagement, preparing for a peer review, or reviewing before your next audit sign-off, this is your rapid access summary of everything the standard covers. The reason a SC 480 demands careful attention is the scale of its consequences. A single wrong classification simultaneously distorts the balance sheet, the income statement, earnings per share, and potentially trips debt covenants without any cash movement. Misclassifications in this area lead to restatements. The governing principle throughout the standard is substance over form. What the instrument is called is irrelevant. What matters is whether the entity has an unavoidable obligation to deliver cash or other assets to the holder. A SC 480 applies to financial instruments that have characteristics of both liabilities and equity, specifically those indexed to or settled in the entity's own equity. The 4 in-scope instrument types are mandatorily redeemable instruments, written put options, forward repurchase contracts, and obligations to issue a variable number of shares for a fixed dollar amount. Employee stock options and awards are outside a SC 480 and go to a SC 718. Derivatives on own equity go to a SC 815. Normal common stock is a SC 505. Category 1 captures instruments where the entity must redeem, not might redeem, and where that redemption is tied to a fixed date or a certain event. Fixed date and death are certain. An IPO and a change of control are not. The certainty of the trigger, not its probability, makes the determination. Category 1 instruments are liabilities from the date of issuance, are accreted toward their redemption price using the effective interest method, and any dividends they pay are interest expense on the income statement. Category 2 is the most counterintuitive of the 3. When an entity's obligation is defined in dollars, deliver shares worth $10,000, for example, the number of shares it must issue is unknown and variable. That is a monetary obligation, economically equivalent to owing cash. It is a liability regardless of being settled in shares. Compare. If the obligation is to issue exactly 1,000 shares, the share count is fixed, the fixed for fixed condition is met, and the instrument is equity. Dollar defined equals liability. Share defined equals equity. Category 3 covers instruments that obligate the entity to repurchase its own shares. A written put gives the holder the right to sell shares back to the entity. The entity cannot refuse. A forward repurchase contract gives the entity no option at all, it must buy. Both create a present liability from the moment they are entered into. Both require fair value remeasurement at every reporting date, with all changes, gains, or losses flowing through the income statement. This is the category most likely to generate surprise P and L volatility. The fixed for fixed principle governs equity classification. A fixed number of shares exchanged for a fixed amount of consideration in the entity's functional currency satisfies the test equity. The moment either element becomes variable, the instrument typically fails. The most common trap, warrants with exercise prices in a foreign currency. The functional currency equivalent of a foreign currency exercise price changes with exchange rates every day. It is not truly fixed. The instrument fails fixed for fixed and is usually a liability. And if instrument terms are ever modified, the classification must be reassessed from scratch. A modification can convert equity into a liability. Initial measurement varies by instrument type. Mandatorily redeemable instruments are recorded at fair value at issuance, typically equal to cash received, and then accreted toward their redemption price through interest expense. Variable share obligations are recorded at the fixed dollar amount owed. Written put options are recorded at their fair value at inception, typically the premium received. Forwards may be 0 at inception if at the money. After initial recognition, Written puts and forwards are remeasured to fair value every single reporting date. All changes flow through earnings, no deferral, no OCI. The balance sheet has three zones under a SC 480. Zone 1 is the liabilities section, for all instruments meeting the three-category tests. Zone 2 is mezzanine equity, the separate section between liabilities and permanent equity for instruments redeemable upon uncertain events outside the entity's control. An IPO that may or may not happen, a change of control, a holder's option. Not certain enough for a SC 480 liability, but not stable enough for permanent equity. Mezzanine presentation is an SEC requirement for public registrants. Zone 3 is permanent equity, fixed for fixed instruments with no redemption features outside the entity's control. 3 journal entry rules to carry into every engagement. First, mandatorily redeemable preferred stock is a liability at issuance, never goes to equity accounts. Second, accretion and dividends on liability instruments flow through interest expense on the income statement, every time. Third, for obligations involving shares, if the obligation is dollar-defined, the credit at the service date goes to a liability account. If it is share-defined, the credit goes to equity. These entries follow directly from classification. Get the classification right, and the entries follow naturally. On the financial statements, each classification zone has exactly one home on the balance sheet. There is no flexibility. Required disclosures include the nature and terms of each instrument, the classification rationale, the redemption schedule, and the fair value measurement methodology. The 6 most common mistakes in practice are all preventable. The default question for shares is always dollar-defined or share-defined. The period-end checklist covers 4 categories: identification, measurement, presentation, and disclosures. All 4 must be complete before sign-off. When working across frameworks, 3 key differences between US GAAP and IFRS matter most. First, convertible debt. US GAAP Post-ASU 2020-06 treats most convertibles as a single liability unit, no bifurcation. IFRS mandates split accounting, which significantly increases interest expense on the same instrument. Second, mezzanine equity does not exist under IFRS. IFRS uses a binary liability or equity classification only. Third, IFRS has a narrow exception that allows certain puttable instruments to be classified as equity in specific circumstances. US GAAP has no equivalent exception. The core classification principles substance over form, variable shares equal liability, fixed for fixed equals equity, are consistent across both frameworks. Every engagement, every new instrument, every contract involving the entity's own shares, the analysis starts with the same 3 questions. Does the entity have an unavoidable obligation to deliver cash or other assets? If yes, this is likely a liability. Is the obligation defined in dollars or in shares? Dollar-defined means liability. Share-defined at a fixed count means equity. Is the redemption trigger certain or contingent? Certain means Category 1 liability. Contingent but outside the entity's control means mezzanine. These 3 questions, asked consistently, catch the vast majority of a SC 480 issues before they become audit findings or restatements. You have completed the full SC 480 Distinguishing Liabilities from Equity training series produced by PNJ Group. Across 6 sections, we covered the financial statement stakes of misclassification, the 3 liability categories, the fixed for fixed equity test, measurement and mezzanine equity, journal entries, presentation, disclosures, and audit expectations. Return to individual sections whenever you need a deeper review of a specific area. Use the period-end checklist consistently. And when you encounter judgment-intensive instruments, escalate them through the proper review chain. Thank you for completing the full SC 480 Distinguishing Liabilities from Equity series. Thank you for watching. Subscribe for more training from PNJ Group.